Welcome back, everyone. So glad you're joining us for a brand new explainer video right here on the GAAP Advisor's Ind AS Clinic YouTube channel. Today, we're diving into something super interesting, a real-world reporting anomaly. We'll be unpacking a fantastic analysis straight from the 234th edition of the Task Weekly newsletter that is authored by CA Manish C. Iyer, director at GAAP Advisors, and published over on LinkedIn. By the way, with over 230 editions out there to date, if you're on LinkedIn and haven't subscribed yet, you're definitely missing out. Go hit subscribe for free. Okay, here's our roadmap for today. 1. Welcome to the clinic. 2. The financial statement observation. 3. Schedule 3 noncompliance. 4. The offsetting prohibition. 5. Obscuring material information. And finally, 6. GAAP Advisors resources.
Kicking things off with Section 1, Welcome to the Clinic, Setting the Ground Rules.
Just to make sure we're all completely on the same page before we start looking at the numbers. The functional currency and the presentation currency for the company we're looking at today is the Indian rupee, so pretty straightforward. Any foreign currency is simply defined as any currency that is not the Indian rupee. And the reporting period? That runs from the 1st of April right through to the 31st of March. Now, I do need to drop a quick but super important disclaimer here. The views expressed in this explainer are the personal views of the author, and they are not binding on anyone. Please always make sure to seek out expert help before taking any action or, refraining from taking action based on what we discussed today. All right, with that out of the way, let's get into the good stuff. Moving right along to Section 2, the financial statement observation, a real-world case. All right, so here is the situation. This observation comes from the published Ind AS financial statements of a listed company. We downloaded and reviewed this independently on a suo motu basis. Now take a really close look at the Other Equity section up on your screen. You want to specifically zoom in on the column headed Equity Instruments through Other Comprehensive Income. I want to pause here for just a second. Put your auditor hats on for me. Look at the flow of those numbers from 2018 all the way to 2020. Do you notice anything unusual about how this presentation is structured? I know, at a quick glance, it probably looks totally standard, right? But the devil is absolutely in the details here. Let's connect the dots. When you put the statement of changes in equity right next to the statement of profit and loss, you can see exactly what they did. They actually took the fair value of equity instruments through other comprehensive income, and they adjusted it with the remeasurement gains on defined benefit plans. They just bundled them all together into one single column. And, well, we're about to see exactly why that is a massive red flag. Which brings us to Section 3, Schedule 3, Noncompliance, the Rule versus Reality. If we pull up the rules, specifically the mandate in Division 2 of Schedule 3 to the Companies Act 2013, the text is crystal clear. It literally says, remeasurement of defined benefit plans shall be recognized as a part of retained earnings or shall be shown as a separate column under reserves and surplus. So did the company do either of those things? Nope. They completely missed the mark. They didn't put it in retained earnings, and they didn't give it a separate column. So right out of the gate, we're looking at a clear-cut Schedule 3 noncompliance. But honestly, it gets worse. Let's look at Section 4, the offsetting prohibition, Ind AS 1 application. Now we hit Ind AS 1, presentation of financial statements, specifically paragraph 32. And it does not mince words. It explicitly states, an entity shall not offset assets and liabilities or income and expenses unless required or permitted by an Ind AS. The company we're looking at basically offset the remeasurement of defined benefit plans with the fair value changes of an equity investment. And let me tell you, absolutely none of the Ind AS permit or require that kind of offsetting. None of them. So how should they have handled this? Well, look at what they did. They created a column headed Equity Instruments through Other Comprehensive Income and just buried the offset inside it. What they really should have done is head that column simply Other Comprehensive Income. Then they could have disaggregated those components in the notes, adding a proper cross-reference from the statement of changes in equity to those notes. If they had just done that, they would have been perfectly compliant. Instead, by choosing that heading and mashing things together, they directly violated paragraph 32. And that leads right into Section 5, obscuring material information, the impact of aggregation. This whole situation is literally a textbook example of what paragraph 7 of Ind AS 1 warns us about, obscuring information. The standard actually tells us that presenting obscured information has the exact same effect on users as just omitting or misstating it altogether. And one of the biggest ways to obscure information? Inappropriately aggregating dissimilar items. I mean, think about it. The remeasurement of defined benefit plans and the fair value changes of equity investments are completely, fundamentally dissimilar items. aggregating them into one column? That just obscures highly material information from the market. Finally, let's wrap things up with Section 6, GAAP Advisors Resources, your compliance toolkit. If you're dealing with these kinds of tricky Ind AS nuances, GAAP Advisors has an incredible free tool for you. Over at gapadvisors.com, there is an issue repository with over 4,500 issues, and their detailed responses covering Indian accounting standards in Indian GAAP. Anyone can register for free. You just submit an issue, and you get a detailed response delivered directly to your registered email inbox. This is a total game changer, especially for auditors who absolutely need to bulletproof their documentation on exactly how they addressed an Ind AS application issue. Also, keep in mind, the observation we dissected today was found in published financial statements. You definitely do not want these errors caught after the fact. Get your financial statements reviewed by GAAP advisors before you sign them. It's super easy. You just send them in a near-to-publishing PDF format via email to info@gapadvisors.com. It's such a simple, vital safety net for any audit or finance team. Oh, and if you found this explainer helpful and want to take a real deep dive into this specific observation, you've got to check out the GAAP Advisors Ind AS Clinic podcast. You can find it streaming right now on Spotify, Amazon, or right here on YouTube. It is the perfect companion to what we covered today.
And that brings us to the end. Thank you so much for hanging out and investing your time with us today. If you learned something new, please hit that like button, add your thoughts in the comments on this video, and make sure you subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. And hey, please share this explainer video with your contacts, your colleagues, your audit and finance teams, and definitely any students pursuing their CA course. It really helps us spread the knowledge of Indian accounting standards. Before I let you go, just think about it. Are your own financial statements hiding similar aggregation errors in plain sight? Something to ponder. Keep learning, stay sharp, and I'll see you in the next explainer.